The traditional investment world, even before annuities came in, was you retired, you rolled your 401k over, and then you tried to live off dividends and interest, the 4% rule. Describe what people used to do before even annuities came out, and maybe spin downs and things like that we're doing now.
Sure. In real brief terms, all this originated with the advent of pensions back in the day. Long before 401ks, there were defined benefit plans, pensions that would pay out benefits every month for the rest of someone's life. Those were very costly to employers. They're very expensive to maintain. So employers moved away from pensions into 401k plans. That put the onus on the saver to figure out how they're going to use the money in retirement. The older way, or I guess the kind of the Wall Street way of using a 401k, is to take all the money and try to grow it best you can, and then withdraw a certain percentage of it each year. Oftentimes that was a 4% withdrawal rate, and you would just try to make sure that those withdrawals were enough to sustain you over time. There's risk with that though. Like we've talked about in previous episodes, there's what's called sequence of returns risk. If you catch some bad runs in the market, you might not reach that safe withdrawal, and you might have less money in retirement or run out of money in retirement. So that's what an annuity can come in and do for you. You could put part of the annuity or part of the 401k or your retirement savings to an annuity contract that would guarantee the retirement income for you, and you still have some money left in the 401k or an IRA or a Schwab account in our case that you could draw from anytime if you need it. So it's all about planning.
And Heather, you want to address the split IRA concept? I think that's what Wes is alluding to, and how that's been a game changer for us and also our clients, to give them that use and flexibility and control we're always preaching about.
Yes, that's a vital part of our planning. Is what Wes mentioned earlier, is we have the Schwab account. That's kind of our liquid bucket. So that's where we draw typically our first initial income for somebody in retirement. That allows the annuity to grow and defer and accumulate. The longer we leave an annuity, especially with an income rider, the higher that lifetime income guarantee is going to be. So we needed to have an outlet to get them beginning in retirement as far as an income flow. And then we transition over into an income annuity, typically, depending on the client, that would sustain them through retirement, along with Social Security or any other defined benefit that they may have.
Mailbox money!
And then it gets into the taxes. I know we have 2 tax certified people on staff, but Trey, I know you can speak to this, but people come in, and there's more and more seminars out there. So one of our clients went to a breakfast the other day. I guess people are having breakfast. I guess it's a little cheaper. I don't know, they went to Shoney's or something. But anyway, they went to a breakfast, and what was the tax-free, what was the deal we did? Remember, we even rented out some movie theaters to talk about that. The tax train is coming. Remember that, Heather? Were you here then?
Power of Zero. Yeah.
Power of Zero. Well, they had the book. So that's even coming back about how to get tax-free retirement, and people are going back. I guess everything just comes back around. They're going to use life insurance now. Folks, be really careful. I've used life insurance for years in retirement, talking about a dangerous tool to try to borrow from and tax-free retirement income, but it's a huge issue. So speak to how we try to deal with what I call that tax tumor, Trey, when somebody decides to hand over their 401k to us, and our obligation moving forward.
Yeah, again, it really just comes down to planning. When someone goes willy-nilly into retirement with all this tax-infested 401k or IRA, as you would say, if they just start yanking money out as needed, they could really throw themselves into some tax trouble. And if they have a game plan that just spreads those distributions across a lifetime with, again, that guarantee that they won't run out with the income annuity, it shows them how they can use and enjoy this money and never run out. The biggest thing, again, with the live well, die broke philosophy, we have a lot of people that come in with quite a bit of retirement assets with absolute uncertainty on how to use it. So they just don't use it, and they never take distributions. Then their RMD hits at age 73 or whatever that'll be in the future, and they have to start yanking money out, and then they have to pay the taxes. And they could have been using and enjoying this money the whole time, but they just never had a plan.
Yeah, and Heather, I was going to say, we had a death claim we had to service the other day, and I think you were in on this, Trey, but family members, our clients, husband and wife, well, they were up in years, but both died pretty close together. It kind of even threw us off a little bit. Their adult children came in. I bet it took me 20 minutes to explain we had to get the RMD first from the death claim of the mother. Then we had to remind them they have to take RMDs, and then in 10 years they got to distribute this. I mean, that tax tumor, people don't realize when they die, they haven't dealt with the tax tumor, the kids get stuck with it. So speak to the importance of getting a plan in place to deal with that tax tumor, Heather.
No, I think you're right. I think a lot of people, hear about the estate exemption and how high that is. And it's like, I won't have to pay taxes when mom and dad die. But if it's in a qualified account, it is most definitely taxable. If that is a concern for clients, especially if they have large qualified accounts like an IRA or a 401k, it is good for us to be able to give them a plan, like you said, Trey, to spend and enjoy some of that while they're living, but then also looking to the future if they're really wanting to have a legacy gift for beneficiaries, we can look at other ways to get those funds to children or beneficiaries in a more tax efficient way. And that could be through Roth conversions, it could be through some sort of insurance trust. There's lots of options that we could have for them, but they need a plan and a way to know how they're going to use their funds for them to enjoy and use. And then also some estate and legacy planning to address those taxes.
Thanks for watching. We hope you enjoyed that video. If you'd like, check out these other clips. And be sure to hit that like button and that subscribe button for more videos.